Everyone wants to build a business, but nobody wants to do the math. Simon J. Lawrence wrote The Layman's Guide to Understanding Financial Statements because he was tired of seeing brilliant people fail simply because they couldn't tell the difference between revenue and profit. Lawrence learned this lesson the hard way. His first bookkeeper was literally stealing his money because he didn't know how to read his own books. Written in 2020, this book has become a staple for one simple reason. It doesn't use the academic jargon accountants use to sound smart. It promises to teach you how to look at a balance sheet and understand in 30 seconds if your company is growing or if you're just rearranging deck chairs on the Titanic. This book has sold thousands of copies. Many probably bought it and were too scared to open it because numbers are intimidating. Today, we're opening it for you. We're going to find out that once you strip away the fear, all that's left are the tools you need to keep from getting screwed.
Concept number 1. The balance sheet equation. Technically, a balance sheet is a report that summarizes the company's assets, liabilities, and owner's equity at a specific snapshot in time. The golden rule here is assets equal liabilities plus owner's equity. To put this simply, imagine you want to buy a delivery truck for your business that costs $50,000. That truck is your asset. It's something of value used to do work. To get it, you put up $20,000 of your own money, which is your equity, and you take a $30,000 loan from the bank, which is your liability. The equation simply says that the value of the truck is made up of your money plus the money you owe others. Think of the balance sheet as a scale. If you buy a new asset with debt, both sides go up. But if the truck's value drops over time, what we call depreciation, while the debt stays the same, it's your equity, your actual wealth, that disappears. Concept number 2. Accrual versus cash method. In accounting, there's a rule called the revenue recognition principle. It states that revenue should be reported when it is earned, not necessarily when it is received. This is the basis of the accrual method. Think of it this way. Imagine you sell a batch of goods today for $1,000, but the customer won't pay you for 2 months. Under the cash method, you haven't earned anything today because your pockets are empty. But real businesses use the accrual method. According to Lawrence, you earned that $1,000 today because the sale happened. You now have what's called accounts receivable. Money that belongs to you but is still in someone else's hands. This is vital because it shows the work you're actually doing. But here's the reality check. If you only look at your theoretical profit and forget that your bank account is physically empty, you won't have the cash to pay your rent tomorrow. Concept number 3. The income statement. The income statement, or profit and loss statement, is a summary of the income and expenditure of a business over a specific trading period. It follows a simple logic. Net income equals revenue minus expenses. If the balance sheet is a photo, the income statement is the movie of the year. It starts at the top with your gross revenue, everything you sold. Then you start peeling away expenses like slices of a salami. First, you take away the direct cost of the goods sold to get your gross profit. Then, you subtract operating costs like rent, utilities, and salaries. Finally, you take away taxes. What's left on the cutting board at the end is your net income. If nothing is left, you aren't running a business, you're running a charity for your suppliers and the government. Concept number 4. The cash flow statement. This document summarizes the cash flowing in and out of your business. It's divided into 3 sections: operating, investing, and financing activities. Here's the truth. You can have a great profit on your income statement and still go bankrupt tomorrow. Why? Because profit is a number on paper, but cash is oxygen. The cash flow statement tells you exactly where your liquid money went. Maybe you made a huge profit, but you used it all to buy a new machine. That's an investing activity. Or maybe you used it to pay off an old loan, a financing activity. If the lung of your cash isn't breathing, your business dies of a financial heart attack, no matter how many sales you've made on paper.
Concept number 5. Owner's equity and retained earnings. Owner's equity is the portion of the company that belongs to the owners. It's calculated by taking the starting balance and adding any new investments and retained earnings. Retained earnings are simply the profits that the company does not distribute to shareholders but reinvests back into the business. Think of it like a fruit tree. Every year, the tree produces fruit. You have two choices. You can eat all the fruit, those are dividends, or you can take some of the seeds and plant them to grow the business. Lawrence explains that retained earnings are the fuel for the future. If you always eat all the fruit, your business will never grow into a forest. It will stay a single tree until it eventually withers away.
Now we've covered the theory, but we are in 2026. The world has changed since Lawrence wrote this, so let's do a reality check. Regarding the balance sheet, today you don't wait until the end of the year to see these numbers. Cloud software does it every second. But if you don't understand the logic Lawrence teaches, you will be a slave to your dashboard. The software might tell you you're okay, but it won't explain that your floating rate debt is about to crush you. The logic of the book is still valid because understanding beats automation every time. On the accrual method, in 2026, digital payments are instant, so the gap between selling and getting paid is shrinking. However, if you sell services, the trap Lawrence describes is still there. If you invoice but don't collect, no AI in the world will save you from a zero balance. A credit is not money until it is in your account. And about cash flow, many people now use AI to predict their cash needs. That's great, but AI doesn't know if your main supplier is about to go bust. Lawrence's advice to personally monitor your outflows is the only way to sleep at night. In 2026, you just need to do it weekly because the market moves too fast for monthly reviews. Now, let's look at some uncomfortable truths that aren't in the book's marketing. First, it's not as simple as it looks. Lawrence says you don't need a degree. That's true, but knowing how to read a balance sheet doesn't give you the guts to make hard decisions when the numbers are red. Most people use this knowledge just to give a technical name to their failure. Second, your accountant is not your father. Lawrence was robbed by his own bookkeeper. Many of you think that paying a professional means you don't have to worry. You're wrong. If you don't understand what you are signing, the legal and financial disaster is yours alone. Third, the revenue trap. I see people celebrating $1 million in sales while they have $10 in the bank. They feel like CEOs, but they are slaves to their debt. Lawrence gives you the tools to see the truth, but 90% of you will still prefer to look at total sales because it makes you feel successful. Finally, discipline versus theory. You can read this book 10 times, but if you don't open your books every single Monday morning, you just wasted your money. Accounting is a daily discipline, and most people simply lack it. If you actually want to apply this book in 2026, here is the execution system. Step 1. Cloud setup. Stop using scattered Excel sheets. Use software that connects your banking and invoicing. Lawrence's theory only works if you use real-time data. Step 2. The Cash Monday. Every single week, open your cash flow statement. Look at who owes you money for more than 15 days and make that uncomfortable phone call. Paper profit does not pay your employees. Step 3. Asset review. Every month, look at your balance sheet. Are your assets still worth what you think they are? If your inventory or machinery is losing value, update the books. Don't lie to yourself about your wealth. In summary, remember these 3 things. Your balance sheet is your compass. Profit is an opinion, but cash flow is a fact. And your company is worth its equity, not its revenue. Is it worth reading this guide in 2026? Yes, absolutely. It is the best vaccine against financial ignorance. Is it brutal? No, reality is brutal. This book is just the mirror that shows you the truth before it's too late. If you want to stop hoping and start knowing, the link to the guide is below. If you'd rather keep ignoring your debt and focusing on vanity metrics, well, I'll see you when you're looking for a video on how to handle bankruptcy. Subscribe to avoid it.